You have a portfolio right now. It looks healthy. Maybe you're up 10% this year. But let me ask you, if the market collapses by 30% in the next 3 weeks, like it did in 2020, what is your buying plan? If you don't have a plan, you are doomed to lose. In March 2020, we saw the fastest, most fatal market crash in modern history. Everything got wrecked. But a handful of investors didn't just survive. They became billionaires overnight by executing one simple strategy: holding dry powder. I'm not talking about timing the market, which is impossible. I'm talking about having the cash, the urgent optionality ready to deploy when the world is panicking, when assets are on sale for half price, and when everyone else is forced to sell. This isn't just about the COVID crash. This lesson applies to every crisis in history, from 1929 to 2008, but 2020 was the perfect, terrifying stress test. We're going to break down the mechanics of the COVID crash, show you exactly how the dry powder strategy works, and give you the precise blueprint for how much cash you need to hold right now so you can turn the next collapse into the best buying opportunity of your life. The problem is that most people believe the market only goes down slowly. They think they will have time to sell a stock or two and raise cash when things get shaky. The COVID crash proved this idea is fatally wrong. In February 2020, the S&P 500 was sitting near all-time highs. Everything looked great. Then, in just 23 trading days, the S&P 500 fell a crushing 35%. That's a massive move that normally takes years to happen. Think about that for a second. You blink, and over 1/3 of your entire stock wealth is just gone. If you had a typical 60-40th portfolio, 60% stocks, 40% bonds, you still got gutted because, during that initial panic, even bonds and safe assets dropped as people sold everything for sheer liquidity. This rapid-fire collapse creates a massive psychological trap. When the market falls slowly, you might be able to talk yourself into holding on. But when the decline is that urgent and fast, the fear is overwhelming. You start thinking, if it fell 35% in 3 weeks, it could fall 50% next week. The average investor is gripped by panic and hits the sell button right near the absolute bottom. They are doomed to sell low and buy high. So the challenge is simple. How do you not panic? And more importantly, how do you buy when everyone else is selling? The answer lies in understanding the difference between a long-term position and a short-term dry powder position. When a crisis hits, two things happen simultaneously in the financial markets: fear and illiquidity. Fear makes people irrational, and illiquidity means the trading market breaks down because there are no buyers. This is why prices collapse so fast. There's simply no one willing to pay the price. The only asset that is immune to this illiquidity is cash. Cash gives you optionality. Optionality is the right, but not the obligation, to make a move. When asset prices are cut in half, your cash position suddenly has double the buying power relative to those assets. Let us look at a concrete historical example of how this dry powder optionality worked during the COVID crash. This is the story of a famous billionaire investor, Bill Ackman. Before the crash, Ackman was concerned about the high valuations in the market. He didn't know a pandemic was coming, but he knew some kind of crisis was inevitable. He took a relatively small amount of capital, around $27 million, and he bought insurance against the debt markets using things called credit default swaps. This was his dry powder preparation. It was a calculated small bet that if the market went completely fatal, he would have a huge pile of cash. When the COVID collapse hit, the debt markets seized up, and Ackman's $27 million bet paid out a staggering $2.6 billion. Think about that. $2.6 billion in cash, ready to go, when the world was on its knees, and every single asset was trading at a massive discount. This massive pile of dry powder allowed him to make moves that an ordinary investor simply could not. He immediately deployed that cash into high-quality companies that were trading at ridiculous discounts: Starbucks, Hilton, Lowe's, Chipotle. These are strong, well-run American businesses that were temporarily gutted by the pandemic lockdown. Within 4 months, as the market rapidly recovered thanks to massive government stimulus, Those positions he bought at half price had more than doubled. He used the cash he created through his strategic dry powder positioning to generate billions. The lesson here is profound. He didn't need to sell his main holdings. He didn't panic. He had a pre-calculated defensive position, the cash, that turned the crisis from a threat into the single biggest opportunity of his decade. This is the power of holding dry powder. It's not about being a bear, it's about being prepared. It's about having a defense that can transform into an offense the second the collapse happens. To truly appreciate this, we need to compare the COVID crash to other historical crises to prove that the concept of dry powder is timeless. Let's go back to the 2008 financial crisis. This was a system-wide fatal failure of the banking sector. The S&P 500 fell 57%. Again, most people were doomed to lose because they had no liquidity. Enter Warren Buffett, the ultimate practitioner of the dry powder strategy. Leading into 2008, Buffett had accumulated a huge cash reserve, topping $40 billion at Berkshire Hathaway. He didn't have a crystal ball. He just saw market valuations getting too high, and he knew a crisis was coming. When the urgent banking collapse happened in late 2008, Buffett was ready. While the entire financial system was frozen, he was the only buyer with immediate, trustworthy cash. He famously made those legendary investments: $5 billion into Goldman Sachs, $3 billion into GE, and later, more into Bank of America. These weren't regular stock purchases. They were high-interest deals that demanded immediate liquidity. Buffett didn't buy those assets because he was a genius who predicted the day of the crash. He bought them because he was the only person with $40 billion in dry powder. His cash gave him the leverage to demand incredibly favorable terms and generate billions in profits for Berkshire Hathaway. His willingness to wait to hold the cash and endure the pressure to invest it paid off handsomely. Without that $40 billion in dry powder, those generational wealth-creating deals were impossible. He would have been like every other investor, simply watching the prices collapse and feeling sick to his stomach. Now, let's go even further back to the Great Depression. 1929. The initial stock market fall was steep, and the subsequent bear market lasted for years. The S&P 500 lost 89%. This was the ultimate deflationary collapse. The key here is that cash gained buying power. Because prices for everything real estate, goods, services were falling, deflation. $1 in 1932 was worth much more than $1 in 1929. The investors who held their dry powder, their cash, didn't just save their money. They actually saw their purchasing power increase. When stocks finally bottomed in 1932 and 1933, they could buy entire industrial companies, which were trading for less than the cash they had on their balance sheets. The investor Bernard Baruch, who held cash through the crash, deployed it in those years and was wealthier after the Depression than before it. The cash became the weapon to buy assets at fatal low prices. So here is the unchanging truth across 1929, 2008, and 2020. Dry powder is optionality. It's the ticket that gives you the right to participate in the most massive wealth transfer events in history. The most common mistake people make when they try to implement this is that they simply keep cash in a checking or savings account. That is a fatal mistake in our modern financial system. You need to understand that the dry powder of today is not the same as the cash of the 1930s. When the Federal Reserve and the government step in, they print money trillions of it, like they did during COVID. This creates inflation, which is a slow but urgent destroyer of purchasing power. If you keep your dry powder in a checking account earning 0.01%, it is constantly being debased. While you are waiting for the collapse to buy assets cheap, inflation is slowly eating away at the power of your cash. You are getting gutted by a quiet enemy. So, the modern dry powder strategy requires you to store your liquidity in places that fight this quiet debasement. You need to use position 1 from the all-weather secret, Treasury bills. Short-term Treasury bills are the ideal storage for your dry powder for several reasons. Safety. They are short-term government debt, backed by the U.S. government. They are the safest, most liquid asset in the world. When the entire market is melting down, T-bills are where institutions flee for safety. During the 2008 crisis, the yield on 3-month T-bills went to zero because everyone was buying them not for return, but for pure safety. Liquidity. You can sell them instantly, which is vital when a crash requires urgent deployment of cash. Return. In the current environment, T-bills pay a real return. In 2022, T-bill yields climbed to 5%. If you were holding T-bills that year, you made 5% while the S&P 500 fell 18%. This is the perfect defense. Your dry powder not only survived the market downturn, but also generated income, giving you a 23% outperformance. This is how your cash fights the fatal effects of inflation while you wait for the next crash. Therefore, the only correct way to execute the dry powder strategy is to hold your liquid capital in a high-quality money market fund, or by directly buying short-term T-bills. This is what Warren Buffett is doing with his $325 billion. He's not keeping it in a checking account. He's keeping it in T-bills. Now, let's talk about the exact allocation. How much dry powder is enough? The answer is, unfortunately, complex because it depends on your age and risk tolerance. But we can use the wisdom of the masters to establish a powerful, simple rule. In normal, stable times, most successful fund managers keep a small reserve. Ray Dalio recommends 5% to 10% cash in his typical portfolio. This is just for day-to-day opportunities. However, when valuations get high, when the market is expensive and the risk of a collapse is elevated, the number changes dramatically. Look at Warren Buffett. In normal times, Berkshire Hathaway holds less cash. But currently, with the market at high valuations, he holds 30% of his entire portfolio in cash and T-bills. That is his signal. He is telling you, the next collapse is coming, and I am preparing for the once-in-a-decade buying opportunity. So, the rule you should follow is a range, based on your confidence and the market's current price. Your dry powder allocation rule. Minimum, in all times, 10% maximum, when markets are expensive, 30%. If you are a young investor, under 40, with a high risk tolerance, holding 15% in T-bills is a perfect amount of dry powder. It's enough to buy a significant chunk of stock if the market crashes 30%, but not so much that you miss out on too much growth when the market is climbing. If you are closer to retirement, over 60, you should lean toward 30% dry powder. You need maximum stability, and the high T-bill yield provides excellent income without the risk of a market collapse wiping out your capital. This cash is not meant to sit there forever. It is an urgent reserve. You must have a pre-written plan for deployment. When the market falls, say 25%, you deploy 1/3 of your cash. When it falls 35%, you deploy the next third. When it falls 50%, like in 2008, you deploy the last third. This disciplined approach removes the emotion. It ensures that when the entire world is panicking, when news headlines are screaming doomed, you are simply executing your plan, buying assets at a fatal discount. The lessons from the COVID-2020 crash were not just about the pandemic. They were about speed. It taught us that the next crisis will not give you warning. It will be fast, and it will be fatal for those who are unprepared. By maintaining your dry powder in the form of short-term treasury bills, you protect your capital against slow inflation and position yourself with the necessary optionality to act decisively when the next collapse hits. You will not be a victim. You will be a buyer. You will not be paralyzed by fear. You will be empowered by cash. You will turn the market's next urgent decline into your biggest personal financial opportunity. This is how generational wealth is created. Subscribe to the channel right now if you want to see exactly which stocks to buy when the next crash comes.